This quarter, we've seen markets sweating the small stuff, with every percentage point outside of consensus and every basis point move thrilling investors. US inflation has seemingly stalled, first quarter GDP and labour markets have been marginally soft, and central banks across the world are still trying to navigate the soft landing that they desire. Equity markets globally had a strong quarter, led by IT and communication services. Global carbon futures were the best performing asset class over the quarter, reflecting positive political sentiment. Gold hit new heights and emerging market equities rose, supported by a weaker US dollar. Conversely, Japanese equities was the worst performing asset class, dragged down by a new rate regime and a weaker currency. It's no revelation that the aftermath of COVID has left governments with higher debts and greater deficits, which is something that doesn't matter until it does. And there are many factors adding risk to these debts and deficits, such as structurally higher funding rates, geopolitics and war costs, impacted supply chains, and the cost of decarbonisation. By the end of 2024, more than 80 countries and more than half the world's population would have been involved in an election, with many resulting in a change of government. This only brings these high government debt burdens and deficits further into the spotlight. So, where to from here? Investing can be a waiting game, and given what will be unfolding over the next 6 months, we think now is the time to wait and remain invested. Nonetheless, there are many pockets of opportunity that smart investors should consider for the remainder of 2024 and beyond. We think a good place for investors to start is to focus on gold. Its clear concerns about inflation and government debt may be helping drive the gold price higher, and we believe gold equities have a long way to run to reclaim their place as a leveraged play on the yellow metal. The data shows that both emerging market equities and bonds offer a greater risk premium than developed markets, who are weighed down by these higher debts and deficits. With emerging market GDP continuing to outperform, as has been for 2 decades now, we believe it would be smart for investors to consider emerging markets in portfolios, although it does play to be selective. Domestically, inflation has yet to be tamed by the RBA, and while new home loan commitments have increased year on year, mortgage arrears are also at their highest level in 5 years. Yet, the economy appears to be muddling through. If the domestic economy and cost of living crisis worsens, investors who are overexposed to Australian banks and cyclicals may feel the pressure. As such, we feel prudent investors should diversify away from these sectors and instead focus on companies with earning resilience, strong balance sheets, and positive free cash flow. Want more? Read our latest viewpoint, The Waiting Game, at vaneck.com.au.